The stock market refers to the collection of markets and exchanges where buying, selling, and issuing of stocks, also known as shares, of publicly traded companies take place. It is a crucial component of the global financial system and plays a significant role in the economy. Investors participate in the stock market with the aim of buying stocks at a lower price and selling them at a higher price, thereby generating a profit. Additionally, some investors opt to hold stocks for the long term, aiming to benefit from potential dividends and capital appreciation. Stock prices are influenced by various factors, including the performance and financial health of the company, economic conditions, industry trends, investor sentiment, and geopolitical events. Investors analyze these factors and use different strategies, such as fundamental analysis and technical analysis, to make informed investment decisions. It's important to note that investing in the stock market carries risks, and the value of stocks can fluctuate significantly. As a result, it is recommended that individuals conduct thorough research and consider their risk tolerance before investing in the stock market. Additionally, seeking the guidance of a financial advisor can be beneficial for making informed investment decisions. The stock market operates under a set of rules and regulations designed to ensure fair and transparent trading. Here are some key rules of the stock market. Listing requirements. To be listed on a stock exchange, a company must meet specific criteria set by the exchange. These criteria typically include financial stability, market capitalization, number of shareholders, and regular reporting obligations. Trading hours. The stock market operates within specific trading hours. In most major markets, such as the New York Stock Exchange, NYSE, and NASDAQ, regular trading hours are Monday through Friday, typically from 9:30 a.m. to 4 p.m. Eastern Time. However, there may be pre-market and after-market trading sessions with more limited liquidity. Order types. Investors can place various types of orders when buying or selling stocks. Common order types include market orders, buy or sell at the prevailing market price, limit orders, buy or sell at a specified price or better, and stop orders, triggered when the stock reaches a specific price, activating a market or limit order. Price transparency. Stock exchanges provide real-time price information for listed stocks. Investors can access this information through trading platforms, financial news outlets, and exchange websites. Price transparency ensures that buyers and sellers have access to current market prices. Insider trading regulations. Insider trading refers to the buying or selling of stocks based on non-public, material information. To maintain market fairness, laws and regulations prohibit insider trading and require company insiders to disclose their trades to the public. Short selling rules. Short selling involves selling borrowed stocks with the expectation of buying them back at a lower price. Stock exchanges have rules governing short selling to prevent market manipulation and maintain market stability. Circuit breakers. Circuit breakers are mechanisms implemented by exchanges to temporarily halt trading or trigger trading restrictions during periods of extreme volatility or significant market declines. These measures help prevent panic selling and provide time for investors to evaluate the situation. Regulatory oversight. Stock markets are subject to regulatory oversight from government agencies or regulatory bodies. In the United States, the Securities and Exchange Commission, SEC, regulates the securities industry and enforces securities laws to protect investors and ensure fair markets. It's important to note that rules and regulations may vary across different stock exchanges and countries. Investors should familiarize themselves with the specific rules of the market they intend to trade in and stay updated with any changes or developments in the regulatory landscape. Investing in the stock market can be a way to grow your wealth over the long term. However, it's important to approach stock market investing with careful consideration and a well-thought-out strategy. Here are some key points to keep in mind when investing in the stock market. Set financial goals. Determine your financial goals and time horizon for investing. Are you investing for retirement, a down payment on a house, or other specific objectives? Clarifying your goals will help you make appropriate investment decisions. Risk tolerance. Assess your risk tolerance, which is your comfort level with fluctuations in the value of your investments. Stocks carry a higher level of risk compared to other asset classes like bonds or cash. It's important to invest in a way that aligns with your risk tolerance. Diversification. Diversify your investment portfolio by spreading your investments across different asset classes, industries, and geographical regions. This can help mitigate risk and reduce the impact of a single investment's performance on your overall portfolio. Research and due diligence. Conduct thorough research on the companies you're interested in investing in. Evaluate their financial health, competitive position, industry trends, and management team. This analysis can be done through fundamental analysis, which involves examining financial statements and company performance, or technical analysis, which involves studying price patterns and market trends. Long-term mindset. The stock market tends to reward long-term investors who can withstand short-term market fluctuations. Rather than trying to time the market, focus on a long-term investment strategy based on your financial goals. Regular monitoring. Keep track of your investments and review them periodically. Stay informed about the companies you've invested in, industry news, and overall market conditions. However, avoid making impulsive decisions based on short-term market volatility. Consider professional advice. If you're uncertain about making investment decisions or if you have a significant amount of capital to invest, consider consulting with a financial advisor. They can provide personalized guidance based on your specific financial situation and investment goals. Risk management. Use risk management techniques such as setting stop-loss orders to limit potential losses and diversifying your portfolio to reduce the impact of individual stock movements. Remember that investing in the stock market carries risks, and past performance is not indicative of future results. It's important to do your own research, seek professional advice when needed, and make investment decisions that align with your financial goals and risk tolerance. As an AI model, I don't have real-time access to current statistics or data. However, I can provide you with some general information about stock market statistics. Please note that these figures are not up to date and should be verified with a reliable source for the most current information. Here are a few common statistics related to the stock market. Stock market indices. Stock market indices track the performance of a specific group of stocks and provide a snapshot of the overall market. Some well-known indices include the Dow Jones Industrial Average, DJIA, S&P 500, and Nasdaq Composite in the United States, and the FTSE 100 in the United Kingdom. Market capitalization. Market capitalization is the total value of a company's outstanding shares. It is calculated by multiplying the current stock price by the number of shares outstanding. Companies are often categorized as large cap, mid cap, or small cap based on their market capitalization. Price to earnings (PE) ratio. The PE ratio is a common valuation metric that compares a company's stock price to its earnings per share (EPS). It provides insight into how much investors are willing to pay for each dollar of a company's earnings. A high PE ratio may indicate that investors have high expectations for future growth, while a low PE ratio may suggest the stock is undervalued. Trading volume. Trading volume represents the number of shares traded within a specific period. It can indicate the level of market activity and liquidity. Higher trading volume often accompanies significant market moves or news events. Volatility. Volatility refers to the degree of price fluctuations in the market. Volatile markets experience larger price swings, while less volatile markets exhibit more stability. Volatility can be measured using metrics such as standard deviation or the volatility index, VIX. Dividend yield. Dividend yield is a measure of the dividend income generated by a stock. It is calculated by dividing the annual dividend per share by the stock's price. Dividend yield is expressed as a percentage and is often sought after by income-oriented investors. It's important to note that stock market statistics can vary significantly depending on the specific market, region, and time frame. To access the most accurate and up-to-date statistics, it is recommended to consult reliable financial news sources, market data providers,